Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. Let's take a look at the state of the consumer with Eric Clark, portfolio manager, Rational Dynamic Brands Fund. Eric, thanks so much for joining the show. Great to have you.
Thanks, Caroline. Good to see you.
Good to see you too. So the Rational Dynamic Brands Fund focuses on consumer stocks trading near a 2-year high with top holdings including Amazon, Live Nation, Uber, Netflix. So I guess the fact that it's trading near a high, what can we draw about the strength of the consumer?
Well, they continue to outperform expectations, right? We all think that the consumer's tapped out and the consumer keeps spending because consumption's in our DNA. And that's what makes them so special as stocks for the long term.
Continuing to spend, but has become increasingly value focused. So how has that changed in terms of holdings in your fund, but also changed in terms of the beneficiaries of that consumer spending?
Yeah, sure. I mean, consumers do spend differently over time, in good times and bad, through pandemics, et cetera. So, when inflation's high for 2 years, we get tired of overpaying for everything. We start to get very trade down oriented, very value focused on, part of our spending in some ways, so we can continue to spend on things that we love, like experiences, concerts, going on vacation, et cetera. So it's a bit of a barbell between trying to save money and trade down, avoiding the middle, which is what we've done from a stock selection perspective on, categories and brands that, like an Etsy, for instance, that isn't really in favor for the consumer. So we can invest in the things that we love and the things that we need. So that's a good barbell of things and the way consumers are spending now. And I don't see that changing anytime soon, because I think reported inflation is a little bit lower than actual inflation that we deal with on a day-to-day.
So we are seeing that consumers are willing to pay up, though, for things outside of experiences that aren't necessarily cheap. And we're seeing that just even with sneakers, in terms of On Holdings has been a huge beneficiary. And those sneakers can cost $150 plus, and then taking market share away from Nike with similar price points, but not necessarily grabbing consumers' wallet share quite as much. So what are they doing to really try to appeal to these consumers that are becoming more choiceful?
Well, they're trying to delight them with good quality, but good prices too. So, particularly now, consumers are finally pushing back on price. So if you're a retailer and you're trying to generate new traffic because your traffic has gone down, you have to lower some prices, which forces you to do some operating efficiencies to keep your margins high. But, keeping the inventory that people love and, paying attention to what consumers are buying. Clearly, they're not buying as much Nike, and they're buying more of, Hoka brand and like you said, On footwear. It really depends on the category, but we certainly do see consumers wanting to spend back on, let's say, home improvement now that rates are coming back down a little bit, which is why we like Home Depot after, it's just now breaking out of the 2021 base. So it's kind of gone nowhere for 3 years and it's just broken out. So that one's certainly an interesting part, which is very correlated to lowering interest rates.
And we'll talk about your other picks in just a second outside of Home Depot. But I do want to ask you about this port strike that we're seeing. Obviously, we don't know how long it's going to last. But as we think about the holiday shopping season and a consumer that doesn't want to pay higher prices, could it have an impact, or are retailers already inventoried up and we don't have to worry about the impact until potentially next year?
Yeah, I mean, generally speaking, they kind of knew this was at least a possibility, and retailers are generally pretty good at getting ahead of things and ordering inventory in advance. So, there might be some, certainly more perishables that could affect the grocery side of the business. But I think largely we're good through the holidays, unless this thing just drags on. I mean, historically these strikes tend to last 2 weeks or less. So let's hope that is what happens here. But generally, I'm not too worried broadly, given the inventory that they currently have. But if they're drawing down some inventory, maybe there's not as many markdowns as possible, which is good for margins, but not as good for consumers. So it's really hard to know how that's going to play out. We know the longer it lasts, the more problematic that it becomes. We saw that in the pandemic. But for now, we're not particularly concerned.
Good point about the markdowns. I guess I need to Christmas shop early just in case. In terms of some of your other picks, you mentioned Home Depot. You also like Walmart and Amazon. Tell us why. And to me, Home Depot, Walmart, Amazon sounds like almost cautious ways to play the consumer. Am I wrong?
And no, you're not wrong. I mean, because the consumer isn't spending broadly, we are kind of clustered up in the highest quality names. And we generally, if our goal is to invest in the great dominant franchises of brands, Home Depot and Walmart and Amazon, between the three of them, it's like $1.5 trillion of top line revenue, which is, about 20% of total retail sales. So they are certainly big 800-pound gorillas in those categories. Walmart is a little bit more on the grocery side with some discretionary. Amazon is certainly 450 billion of revenue on the retail side. Plus, they have a growth kicker in AWS and the AI that I think is undervalued. But Walmart just has provided that value to the customer. Their e-commerce division is rapidly reaching profitability. And Amazon obviously is doing really well on the retail side and on the AWS side. And, the cost to serve and using AI in your business to create operating efficiencies and drive margins higher is a big theme we see across most of retail.
All right, Walmart and Amazon both higher today. Or actually, I'm sorry, Walmart is lower today, Home Depot higher today. Another pick on your list I see is Apollo Global Management. Tell me how this one fits in.
Well, consumers are investors. And, on the margin, a huge trend in our own industry is on the margin, some money being carved out of public equities and public fixed income and going into privates. And it's odd. 80% of the economy is still private companies, and very few investors have any exposure at all to these, to privates. And so you can either invest in the stocks, and they are incredibly underowned, by the way, and have been monster performers since going public. And I would, Apollo, KKR, Blackstone are the three that we own. It's about 15% of the fund, but they are increasingly making it easier for investors through their advisors to get access to private infrastructure, private credit, private real estate, and they're kind of blurring the lines between public and private. And you're talking one or two in the inning area. So I think there's trillions and trillions of dollars that eventually are going to get carved out of publics and go into privates. And these three brands are, the lion's share of the flows. And Apollo just did an investor day, their first one in 3 years yesterday. Management absolutely did not disappoint. The stock was up 5 or 6% yesterday, up another percent and change today. And it's still the cheapest of the three, and they all pay dividends and grow their dividends. So these are some of the smartest investors out there, and very few people own the stocks, which makes them, continuously interesting. And we certainly love to buy those on dips because sometimes they can be a bit volatile.
All right, so it's up 7% just in the past 2 days, as you noted, up more than 40% year to date, and it's not too late to get in.
I don't think so. Apollo is cheaper than all the other ones, and that still needs to be added to the S&P 500, which could be a pretty good catalyst as well.
We'll leave it there. Eric Clark, Portfolio Manager, Rational Dynamic Brands Fund. Thanks so much for those picks.
Thanks, Caroline.